Hi, good morning. So today we will try and talk about IFRS 9, the concepts of IFRS 9, and we'll discuss um, some parts in detail and some parts in short because this is a crash course of IFRS 9. So we'll try and keep it short so that you can understand this well. Okay, so let's get started with the need of IFRS 9. What is the need? Where it has come from? Why there is a need of implementation of IFRS 9. Okay, so as you might have seen in our YouTube videos also, there are two main reasons because of which IFRS 9 was introduced. Number one is actual credit loss model. And number two is complexity of IS 39. So these were the two reasons because of which IFRS 9 was brought into picture. Now I'll just give you a brief of these two things. Number one is the actual credit loss model. Now it has changed to expected credit loss model in IFRS 9. Why it was changed? Let us throw some light on it. So what happened when there was a recession occurred in 2008 because of subprime mortgage crisis? You might have read about it. So the crisis was not a you can say the crisis was not because of IS 39 or any of the standard, but it was the effect was worsened because of IS 39. And how come? Let us talk about that, because we are not here talking about how economic recession came in. We are just talking about how IAS 39 helped it worsen the effect of the economic recession. So number one is this economic recession started because of excessive loan given to consumers whose creditworthiness was not even so well. So in that case, because of such loans, when there was a huge mortgage out of was given out of the banks, the risk was increased, and such risk was not brought into picture, you can say disclosed in the financial statements of such banks because of this actual credit loss model. Because in IS 39 what was used to be is whenever there is a default, then only IS 39 allows it to book as a bad debt provision. But now IFRS 9 works on expected credit loss model. It says that whenever there is a you can say a loan given to a customer, there is an expected bad debt provision based on the nature of such loans. Just like in case if we talk about banks, suppose a bank is giving agricultural loans to a lot of people, so they knew it in advance that in as a past practice 2% is on an average is the bad debt in any agricultural loan. Hence, as per expected credit loss model, as and when you decide to book the entry for giving the loan, in the same year itself you have to book a bad debt provision based on the past estimate. This is what IFRS 9 says. But IAS 39 was based on actual credit loss model, which we talked about just now. Because of that economic recession, there was no losses in the books of banks which could not be caught. Hence the you can say the economic scenario was not presented on the balance sheet of the banks. Hence this step was taken and IFRS 9 was brought in with this concept, right? Number one, this. Second was the complexity of IAS 39. If whenever when we'll move forward and see in the upcoming lectures, we'll compare it with IAS 39. There are a lot of things where it was like IAS 39 was a rule based concept, it was not a principle based concept. So it was a rule based where it is written, suppose in case of hedging, if we talk about, they say there is a, if there is 85% to 125% estimate, or you can say there's a hedging, they say like if your hedging estimation falls between these two variants, then only you'll account for hedging in some instances. We'll talk about, because I cannot explain you right now, you don't know the concepts straight away. So there were some rule based concepts based upon such rules, which was, we don't know where it came from. So IFRS 9 was made very simpler. One more thing, that in IAS 39 there was 4 classification of financial assets and liabilities, which was held to maturity, available for sale, loans and advances, held for trading, right? But in IFRS 9 it has been reduced down to 3: FVTPL, FVOCI, and amortized cost. Now what is all this? Let us understand this step by step, going into it conceptually. Okay, so we'll move forward and talk about, this is the case study we are not discussing here because it is a crash course. I have to finish these lectures very soon, but you can read it, you can understand it from the internet, or you can take our full course now on our website. You can take it when we have explained each and everything. So what is a financial instrument? Now we'll come on the definitions of financial asset, liabilities, and financial instrument. What is a financial instrument? Now financial instrument is a contract, any contract that gives rise to a financial asset for one person, financial liability for another, is a financial instrument. Okay, so for an example is you can say a derivative. Suppose I bought a put option or a call option, when two parties are involved. One is for one party it is an asset, for one it is a liability based upon the prices in the market. That's why it is called a financial instrument. Now, what is a financial asset and financial liability? Financial asset is everything. We'll talk about this like let us take an example from the balance sheet. Okay, we'll read this definition and apply it to the balance sheet. Okay, now financial asset is any asset that is cash. So basically cash is a financial asset. It is very clear. Now number 2, a financial asset is any asset that is an equity instrument of another entity. So whenever you make an investment in equity, that is also a financial asset. Okay, now number 3, a contractual right to receive cash. Now third is debtors. This is a contractual right to receive cash. Okay, sorry. Now fourth point is to exchange financial asset or financial liability with another entity under conditions that are potentially favorable to the entity. Now what is that? This we call as options or derivatives, you can say. Just like I talked about, suppose I bought a call option and it is in my favor. That's why it is written over here that are conditions that are potentially favorable. So whenever it is in my favor, I will book it as a financial asset, right? So the third point is for derivatives, and the next point is contractual right, contract that is settled in own equity instruments. So if there is any contract which is settled in own equity instruments, you can say, like if we talk about exchange of assets through equity instruments, then it is also a financial asset. Okay, we'll talk about it more in the upcoming lectures when we'll talk about examples. Okay, Then the third part is what is a financial liability. Now financial liability is also, these were financial asset. Now what is financial liability? Financial liability is simple, the same definition goes here, any liability that is for a contractual obligation to deliver cash. Okay, so any loans, for which you have to pay cash, creditors, that is also your financial liability. To exchange financial asset, financial liability with another entity, to exchange financial asset or financial liability with another entity under conditions that are potentially favorable, this goes for derivatives, right? Derivatives. So let's not go into depth of these definitions right now over here. When we'll do practical illustrations, you'll come to know and you'll understand this very easily. So it is very simple, right? This was financial asset and financial liability. Now what is an equity? You all know what is the equity. Will not go into the definition. The contractual residual interest, you may read it on your own, you can download the notes. This is nothing to go into detail, right? The main point what I'm discussing here is how to attempt your questions for diploma in IFRS exam, and basically summarizing all the concepts in IFRS 9. This is what we are doing here. What is a derivative? Which derives its value from an underlying asset, that is a derivative. Just like options, just like futures, these all are derivatives. Okay, interest rate swaps, forwards, everything. Now compound financial instrument. A compound financial instrument is basically convertible instruments like convertible debentures, convertible preferences. All these are compound financial instruments because they contain two you can say components. One is for equity, because after conversion it will be equity, and one is for liability, right? That is why it is called compound financial instruments. IAS 39 was having a different accounting treatment for compound financial instruments, but in IFRS 9 there is no different accounting treatment. You have to classify them according to the classification criteria, right? Now what is the classification criteria? So this was just the basic overview of IFRS 9. Now we will understand, now let us understand the whole picture of IFRS 9. Okay, so I'll start with it here. Okay. So basically in IFRS 9 we will understand, first we have gone through the definitions, right? Now we'll go for what is the classification criteria in IFRS 9, right? Number 3 will go for recognition and measurement. Okay, 3 we will go for there, and last we will go for the disclosures. Okay, so first of all, let us summarize, let us understand the concept of IFRS 9 through its classification. So see, what is classification of IFRS 9? See, in IAS 39 there were 4 classification which we talked about it earlier in this lecture. Now IFRS 9 has classified them into 3 parts based upon the business model, or you can say what is the intent of the finance heads or the company heads. What is the intent of the company? The main motive is to represent, or you can say present, the intention of the company on the books of accounts. That is the main reason, right? So they have classified into 3 criteria based upon the intent, or you can say based upon the business model of the company, right? So there are 2 tests which are done in classification, while any classification, right? Now why we are classifying? First of all, there is a question, why we are classifying? Why there is a need to classify into any of these? What will happen? So I'll take a small example of gratuity. You all know about gratuity. I assume that the people who are watching this might have worked somewhere else and they might know the importance of gratuity provision in the books, because a single entry of gratuity provision may impact the profit very badly, right? Because it is also an actuarial provision, you can say, based upon actuarial calculations, right? Now we'll talk about gratuity. So suppose what happened was, in a company there was a gratuity provision of let's say 1 crore. Okay, and at that time, or you can say this was in 2017-18, right? Now, and the profit of that company was let's say 5 crore. Okay, okay. Now in next year 2018-19, this gratuity provision increased to 2 crore, double. We don't know how, because practically speaking, if you go into this, nobody knows how. Only the CFO or the head of the finance only knows how this is coming, because they only deal with this kind of thing. Or otherwise, if you have time, you can go into this and you can understand the actuaries calculation. Okay, so it is double. Now what is the reason why it is double? Nobody knows, we don't know. Okay, and the profit dropped down in 18-19. Profit dropped down, let's say, assuming it was same 5 crore, now it dropped down to 3 crore, let's say. So it has a huge impact. Now see, because there was only an actuarial calculation involved, there was no actual loss in such case, in case of gratuity, right? Similarly, in case of any employment benefits, employee benefits, wherein actuarial calculations are involved, there are no actual losses, but we are provisioning high because this is an estimate. These are based upon estimates. So what happened is the company's profitability varies a lot. In first year it was 5, then it was 3. Now let's say, suppose next year the actual calculation says it's 50 lakhs, and profit moves up to you can say 6 crore. So nobody knows it, we can't explain it, why it is going up and down, hey, why, you cannot explain it to investors. So it is very difficult, right? Hence they brought in a concept of, similarly, I'll give you another example. Similarly, in case of assets, revaluation, right? There's a revaluation concept in assets, or revaluation of land, let's say. Now in previous year, land was in our books of accounts was 5 crore. Now land value increased, and it increased to 10 crore. It was revalued after 2-3 years, and we suddenly got it that it is 10 crore. So in that case, when the value increases, you have to give the second impact somewhere over here. What will the entry be? It will be land account debit. What's happening? Sorry. Land account debit to P&L. This would be the entry. And suddenly the profit increased by 5 crore. Nobody knows why. And next year you do it. Next year, suppose the revaluation guide based upon which we are evaluating, he says no, land is 8 crore rupees, so you have to reduce the profit again by 2 crores. So there is no actual increase or decrease in the profit or operational profitability, and it makes very difficult for company, or you can say the investor, to understand why the profit is going haywire, right? So in that case, the concept was introduced, which is called as other comprehensive income, which is part of P&L, and you can say profit loss, which is called as comprehensive income or other comprehensive income. This is the profit loss statement. So P&L is basically divided into two parts. Second part is other comprehensive income. When you'll see the statements, you'll come to know. So any such increase revaluations, gratuity provision change, all such increase goes to other comprehensive income. Similarly, in case of financial assets, or you can say whenever there is a derivative, you have a derivative contract which is expiring in the next year, but you have a balance sheet ending date in between, right? So in that case also you have to revalue it according to market, but you don't know whether it will be an actual loss or profit or not. So there is also a you can say a provision where you can, this can impact your profitability. There's some estimate involved, right? In other cases you can say like just bad debt provision and everything, or you can say you have invested in a company wherein you don't want to sell that investment in a short term, you want to hold it for a long term. So all these business decisions impact your profit, and your profit varies because of one or the other reason which is not related to not directly related to your operational profitability. So that's why the concept of other comprehensive income was introduced, which takes into account all the other factors which is not directly related to our operational profitability, right? So we'll discuss what will come under other comprehensive income, okay? But this was the main reason, so that profit which is looking into the profit and loss statement should be you can say justified, right? Why? If it is an increase in profit, we can justify why there is an increase. It should not be like just the provision is increasing of or that there is some revaluation increasing our profitability, right? So this was the main reason. Now based upon this scenario, the classification of financial assets was required correctly, because whenever you require it, whenever you classify a financial asset, it will impact, you have to decide basically which will impact your P&L or which will impact your other comprehensive income. This is the simple classification does, right? And all these three classification which we are going to study, we will just understand which will impact our P&L and which will not. This is as simple as that, okay? And this is based upon the business intention or business model of the company, right? So there were three classifications mentioned in IFRS 9. Number one is subsequent measurement. Now see why they have written subsequent measurement at amortized cost. Subsequent measurement at amortized cost, or subsequent measurement at FVOCI, subsequent measurement. Why this is subsequent measurement? Because initially you have to classify them, but measurement will be done at the reporting date, right? Initially you have to classify them and measure at their actual values or transaction values. In some case it will differ, I'll tell you, but at the balance sheet date, or you can say at closing date, you have to. This is called subsequent measurement. Subsequent means at the balance sheet date you have to measure them at amortized cost, or FVOCI or FVTPL. Okay, sorry, right? So this is why this is called as subsequently measured. So we'll talk about this classification of financial asset and in more detail in the next lecture. Till then, wait, that's what I can say. Thank you.